Most people believe the stock market is a level playing field. They are told that anyone can open an account, buy shares, and grow wealth over time. The rules appear simple. Buy low, sell high, hold long enough, and the market rewards patience. That story sounds fair. It sounds democratic. It sounds empowering. Hey? And it hides the most important truth about modern markets. The stock market is not designed to reward participation. It is designed to reward position. And institutions start every game already standing on higher ground. If you want clear explanations of financial systems that quietly favor insiders while ordinary participants absorb the risk, subscribe to Insider Expos. This channel exists to explain what market language is designed to conceal. To understand why stock market rules favor institutions, it is necessary to abandon the idea that the market is just a place where buyers and sellers meet. The market is a rule book, and every rule shapes who wins, who loses, and who survives volatility. Institutions are not better because they are smarter. They are better because the system gives them advantages that individuals can never access. The first advantage is speed. Institutional traders operate at speeds measured in microseconds. Their systems sit physically closer to exchanges. Their orders reach the market before retail orders even register. This is not an accident. Exchanges sell speed. Faster access costs money. Institutions can afford it. Individuals cannot. This means institutions often see price changes first. They react first. They capture spreads before retail investors even know movement occurred. Over millions of trades, this advantage compounds into enormous profit. Retail investors are always last in line. The second advantage is information. Institutions do not rely on public news headlines. They pay for proprietary data, order flow data, market depth data, alternative data pulled from shipping logs, satellite imagery, credit card activity, and supply chain metrics. By the time information reaches the public, institutions have already positioned themselves. News does not move markets for them. It confirms decisions they already made. Retail investors trade on narratives. Institutions trade on signals. Then there is order structure, which most people never see. When a retail investor places a trade, that order often does not go directly to the exchange. It is routed through intermediaries. Market makers internalize trades. Orders are matched off exchange. Prices are adjusted within legal limits. This practice is framed as efficiency. In reality, it allows institutions to profit from the gap between what retail traders expect and what actually happens. Retail orders become predictable. Predictability becomes profitable. Institutions also benefit from scale. Large funds move enormous volumes. They negotiate lower fees. They receive rebates. They access lending markets at better rates. They borrow shares cheaply. They short easily. They hedge efficiently. Retail investors pay higher costs on every action: trading fees, spread costs, slippage, tax inefficiencies. These costs feel small. Over time, they erode returns dramatically. Scale turns friction into advantage. Then there is access to leverage. Institutions borrow at rates close to risk-free. They use leverage strategically. They amplify gains while managing downside with complex hedging strategies. When leverage creates instability, central banks intervene to protect the system. Retail investors face margin calls. Institutions receive support. This difference is not theoretical. It defines survival during crises. During market crashes, volatility explodes. Prices swing violently. Liquidity disappears. Retail investors panic because their time horizon is short and their margin for error is small. Institutions thrive in this environment. Volatility increases trading profits. Forced selling creates opportunities. Distressed assets appear. Algorithms harvest fear. While retail investors are told to stay calm, Institutions are actively extracting value from the chaos. Then comes regulation, which many believe protects individuals. Regulation does not level the playing field. It raises the barrier to entry. Compliance is expensive. Reporting is complex. Legal interpretation requires teams of specialists. Institutions absorb these costs easily. Smaller players struggle. New competitors never emerge. Rules that appear restrictive often entrench incumbents. Even worse, institutions help write the rules. They lobby regulators. They advise policymakers. They provide expertise that shapes legislation. The result is regulation that sounds strict but preserves institutional advantage. Thresholds are introduced. Exemptions are carved out. Complexity multiplies. Retail investors see protection. Institutions see opportunity. Another critical advantage is time. Institutions are not judged daily. Retail investors are. A pension fund can hold losses for years. A hedge fund can restructure positions. A bank can roll risk forward. Retail investors face emotional pressure, financial pressure, and liquidity pressure. Time flexibility changes behavior. Institutions can wait. Retail investors are forced to react. This difference alone explains most underperformance. There is also the issue of market access. Institutions participate in pre-market trading, after-hours trading, private placements, initial public offerings, secondary offerings, debt markets, derivatives markets. Retail investors enter later, pay higher prices, and absorb dilution. The most profitable stages of investment often occur before the public arrives. When retail investors finally participate, institutions are already managing exits. Then there is tax structure. Institutions optimize tax treatment through jurisdiction, structure, and timing. Losses are offset. Gains are deferred. Taxes are minimized. Retail investors pay taxes in real time. Capital gains reduce compounding. Mistakes are punished immediately. Taxes quietly widen the gap. The stock market also rewards narrative control. Institutions influence research, analyst coverage, ratings, market sentiment, corporate guidance, media framing. Retail investors consume the finished story. Institutions help write it. This does not require conspiracy. It requires alignment. Access creates influence. Influence shapes perception. During bull markets, institutions distribute risk. During bear markets, institutions accumulate assets. Retail investors provide liquidity both ways. This is not a coincidence. It is how the system clears. The most important realization is this. The stock market is not designed to make everyone wealthy. It is designed to allocate capital efficiently within a hierarchy. Institutions sit at the top of that hierarchy. Retail participation is encouraged because it provides liquidity, stability, and exit opportunities. But participation does not mean equality. The rules are the advantage. That is why institutions can underperform for years and still survive. That is why they recover faster after crashes. That is why they grow larger over time. Losses are absorbed. Mistakes are managed. Survival is protected. Retail investors experience the opposite. Errors compound. Timing matters more. Costs accumulate. Pressure intensifies. The market rewards those who control structure, not those who simply follow rules. This does not mean individuals should avoid markets. It means they should abandon the illusion of fairness. Understanding the system changes expectations. It shifts focus from beating institutions to avoiding their traps. Because the stock market is not a test of intelligence. It is a test of position. And until the rules change, institutions will continue to win not because they predict the future better, but because the present is already tilted in their favor. If this changed how you see the stock market, subscribe to Insider Expos. Every episode breaks down how financial systems quietly benefit insiders while presenting the illusion of opportunity to everyone else. Because once you see the rules clearly, the real risk is no longer market volatility. The real risk is believing the game was ever equal.